We will now look at incomes not forming part of total income. That means incomes exempt from tax. First, we will look at agricultural income. What is agricultural income? Following incomes, which you can see in this table, from land situated in India and used for agricultural purposes is agricultural income and it is exempt. Number 1, rent or revenue from such land. We need to note, however, that income from transfer of an urban agricultural land, that means which is not in a rural area, is not agricultural income and therefore it is not exempt. It is taxable as capital gain. Second, income from such land by agriculture, it is exempt. What we need to note is income from saplings or seedlings grown in a nursery is also deemed to be agricultural income and is therefore exempt. Third, income from such land by performance of compulsory process. Or 4, by sale of produce on which only compulsory process has been performed. So if only the compulsory process has been performed, income is agricultural income exempt from tax. But if there is any further processing, then that results in a composite income, that is partly agricultural income and partly business income, and the composite income needs to be split. Fifth, income from a building which is required as a dwelling house or a storehouse or other outbuilding, which is either assessed to land revenue in India or subject to a local rate, or it is not situated in an urban area. In these 5 cases, the income from land situated in India and used for agricultural purposes is exempt. Now we noted above that if any extra process beyond compulsory process has been performed, then composite income arises and then it needs to be split. There is a general rule and there are special rules. First, we will look at the special rules, and there are 3 special rules. Rule 7A applies to income from manufacture of rubber, in which case 35% is taxable as business income and the balance 65% is exempt as agricultural income. Then we have Rule 7B, which covers income from manufacture of coffee. In this case, where it is a case of sale of coffee which is grown and cured by the seller in India, then 25% is business income and 75% is exempt as agricultural income. But where it is a case of sale of coffee which is not only grown and cured but grown, cured, roasted and grounded by the seller in India, then a higher percentage of 40% is business income and the balance 60% is exempt agricultural income. Then we have Rule 8, which covers income from manufacture of tea grown and manufactured by the seller in India, in which case 40% is business income and the balance 60% is agricultural income. Where a special rule doesn't apply, we apply the general rule, in which case where there is a sale of agricultural produce, where no processing has been performed or only compulsory processing has been performed, we have noted above some time back that this is pure agricultural income exempt from tax. However, where there is an extra processing which has been done, it results in a composite income and then it needs to be split between the business income and agricultural income. How do we determine the amount of agricultural income? First, we figure out the market value of sales proceeds, from which we deduct the amount of cultivation expenses, which gives us the amount of agricultural income. How do we determine business income? We determine the sales proceeds of the produce in the market. From that, we reduce the market value of sales receipts of agricultural produce which has been utilized as raw material. So basically, this market value of sales proceeds which we had considered while determining agricultural income is what we reduce, and we further reduce manufacturing expenses, and this gives us the amount of taxable business income. The agricultural income is partially integrated with the non-agricultural income for the purpose of levy of tax, and this method applies only in the case of an individual, HUF, AOP, BOI or artificial juridical person, and 2 conditions need to be satisfied for partial integration. Number 1, the net agricultural income should be greater than 5,000 and 2. The total income, which is the non-agricultural income or the taxable income. The total income should be greater than the basic exemption limit, which will either be 2.5 lakh or 3 lakh or 5 lakh as the case may be. And then the tax liability is computed as you can see on your screen. So first we compute A. A is what? Tax on net agricultural income plus the total income. Then we compute B, which is what? Tax on net agricultural income plus the basic exemption limit. Then tax on the total income is A minus B. It is equal to A minus B, from which we reduce the amount of rebate under section 87A if it is applicable, or add surcharge and then add HEC at the rate of 4%, and which gives us the amount of tax liability. This is about agricultural income. Section 10AA makes special provisions in respect of newly established units in special economic zones. And this provision applies to an SSE to a person who begins to manufacture or produce articles or things or provide services in any SEZ during the period 1st April 2005 to 31st March 2020. But this cutoff of 31st March 2020 is extended to 31st March 2021, provided the letter of approval under the SEZ Act is issued on or before 31st March 2020. If this condition is satisfied, then the quantum of the deduction under section 10AA is in the first 5 years, beginning from the year in which the unit begins to manufacture, produce or provide services. It is 100% of the profits derived from export. For the next 5 years, 100% is reduced to 50%. And in the subsequent 5 years, the deduction is equal to lower of 50% of profits derived from export, or the amount which is credited to SEZ, RRA or the Special Economic Zone Reinvestment Reserve Account. So deduction is available for a total period of 15 years. So deduction is based on profits derived from export. This means profits of the business of SEZ unit multiplied by a ratio. What is the ratio? Export turnover of SEZ unit divided by total turnover of the business carried on by SEZ unit. So this is the ratio: export turnover of SEZ unit divided by total turnover of SEZ unit, and this ratio is multiplied to profits of business of SEZ unit. This gives us the amount of profits derived from export. Now export turnover doesn't include two items. One, it doesn't include freight or telecommunication charges or insurance attributable to the delivery of the articles or things outside India. Second, it doesn't include expenses incurred in foreign exchange and rendering of services outside India, including computer software. So if these amounts are included, we exclude. Now, if we exclude these from export turnover, logically, if we also then exclude them from the total turnover. How is deduction under section 10AA allowed? It is allowed from the total income computed under the Act before giving effect to this deduction. But please note that deduction under section 10AA cannot exceed such total income. So total income cannot become negative on account of this deduction. We will now look at certain other exemptions provided by section 10. Under section 10(2), a member of HUF is provided exemption on account of any sum paid out of income of the HUF. Section 10(2)(a), exemption is allowed to a partner of a firm on what? On the share in the total income of the firm. However, please note that interest, salary, bonus, commission, remuneration received from the firm is taxable in the hands of the partner under the head PGBP. And this is something that we will talk about in the topic on PGBP. 10(4)(2)(i). In the case of an individual, interest on non-resident external account in any bank in India is exempt. 10(10)(b)(c). In the case of an individual or his legal hire, compensation which is received on account of any disaster from the central government or state government or a local authority is exempt. 10(10)(d) is life insurance, which we will see in some time. 10(11)(a). For in the case of any person, any payment from Sukanya Samriddhi account is exempt. 10(16) is scholarship which is granted to meet the cost of education is exempt. 10(17) in the case of a member of parliament or member of legislative assembly Daily allowance and constituency allowance is exempt. Section 1017A. In the case of any person, what is exempt is any award or reward instituted or approved in the public interest by the central or state government. And 1043, in the case of an individual, any amount which is received as a loan, whether in lump sum or in installment, is exempt if it is received in a reverse mortgage scheme. Now we noted above that any sum received under a life insurance policy is exempt. So we need to keep in mind that there can be three situations. If it is a situation of a key man insurance policy, the proceeds are taxable whether received on the death of a person or otherwise. If it is a case of an excess premium policy, then it is taxable, but it is exempt if received on the death of a person. In the case of any other policy, the proceeds are exempt, whether received on the death or otherwise. Now, as we noted, in respect of an excess premium policy, if the proceeds are received otherwise than on death, then the proceeds are not exempt, they are taxable. So the question is, what is an excess premium policy? And it depends on the date of issue of the policy. Where the policy is issued from 1/4/2003 to 31st March 2012, then the policy is an excess premium policy if the premium payable for any of the policy year is greater than 20% of sum assured. 20%. If the date of issue of policy falls during the financial year 2012-13, then the policy is an excess premium policy where premium payable for any of the policy year is greater than 10%. So 20% is reduced to 10% of the minimum sum assured. And on or after 1st April 2013, this is the position, and there are two categories. In the case of an insured with disability, which is referred under section 80U, or who suffers from a disease specified under 80DB, the threshold is 15% instead of 10%. That means premium payable for any of the policy year is greater than 15% of minimum sum assured, then the policy is an excess premium policy. In all other cases, the threshold of 15% is reduced to 10%. We also need to keep in mind the provisions of section 14A, as per which no deduction is allowed of what? Of an expenditure incurred by the assessee in relation to exempt income. So expenditure related to taxable income is allowed as deduction, but expenditure which is incurred relating to exempt income is disallowed. It is not allowed as a deduction.